biggest wealth transfer in history has just started. The Nasdaq is down 25% and the S&P 500 is down. Pretty much every stock feature is down. But what if I told you that this is probably one of the best times to invest ever? Julep. Remember the days where all stocks were in the green and everything was rallying? Those days are pretty much over. So there's three main reasons why the market is down, and the first is inflation, the second is rising interest rates, and the third is uncertainty. These three main factors causes a wide sell-off, and pretty much every retail investor is too afraid to invest in this market. A lot of people say you should not invest in a market and try to catch a falling knife. Even though mentally it's very difficult to invest in times like these, this is probably the best time to buy more stocks. The worst thing to do is to get out of stocks or not to buy the dip, because these are opportunities that we won't see again anytime soon. If we consistently buy the dip and dollar cost average or rand cost average into our favorite stocks, this will give us great returns over the long term. We just need to stick to our strategy and remember that investing in quality companies is a long-term game and definitely not a get-rich-quick scheme. Okay, so I'm back in Bloemfontein and I filmed this video over the course of a few days because I wanted to share a few extra things with you guys. So now that we know that investing is not a get-rich-quick scheme, there's definitely a hell lot of opportunity when we invest in good quality companies and we put enough money aside to buy the dip when we see that the market goes down. Opportunities like these don't really come too often, and that's why I decided to make this video, because this is something where I took the risk and invested the capital that I had available. I'm just talking to you guys with no formal financial experience. I don't have any degrees or anything like that, and I'm just a normal guy like you guys, or maybe if you are a girl watching. There's no difference between me and you, and it's definitely possible for each and every person watching this channel to achieve great success when investing in stocks. Investing in stocks has become an addiction for me, and I really try to do my best to do the necessary research before buying into a company. I keep a watch list of companies that I really like, and as soon as I see that it hits a price target, I will invest my saved money into that stock. As you can see on my screen, I get myself some sticky notes, and I remind myself to buy the dip on companies that I really like. And that's basically this part of the video that I want to show you guys. How can we determine whether it's a good time to buy into a company or not? Although this is by no means the only research we need to do when investing into a company, this is a good starting point for people that has a watch list. Let's say, for example, you've been watching a few companies and you just want to get the best time to buy into that specific company. So with that said, what I'm going to do is I'm going to share my screen with you guys, and I'm going to explain a few things, and hopefully you can follow along, and hopefully this can actually help you to understand the process that I follow to buy good stocks. So first of all, I'm going to share a few companies with you guys, and from there you can obviously do your own research to determine which stocks you actually want to invest in. The first one I'm going to start with is Tesla. This is obviously a company or mega cap company that a lot of people are talking about. And what I've done is I've done my research on this company. I'm not going to tell you guys if I'm invested in this or not, but hopefully you can kind of figure out the way I'm talking about the company, whether it sounds like a good investment or not. If we look at stuff like profitability, the evaluation, the financial health, and the growth aspects of Tesla, we kind of get a mixed feeling about this. The only thing that's really quite impressive is Tesla's growth potential. And I'm not going to go into too much detail with this. What I'm going to do is I'm going to jump straight to Tesla's financial statements. And obviously we can spend a lot of time on the financial statements, the income statement, balance sheet, and obviously the statement of cash flow. For the productivity of this video, I'm just going to show you guys a really quick summary of the things that we need to look at when investing in a company. So the first thing that we look at is an income statement, and we look at the top line, which is the total revenue. It's called the top line because it's actually the line item at the top of your income statement. And what we want to see is we want to see the total revenue needs to be growing in the past few years. Clearly, here we can see that Tesla has been growing their revenue tremendously, and this is a really good indication for us as investors. When I click on this, here we can actually see how the revenue has been growing. So this is a good indication and a good starting point. Besides the revenue, we want to see that Tesla has been growing their gross profit. Same with the revenue. We want to see an uptrend with this. And clearly, Tesla has been doing just that. These two are a great way to get started when we look at an income statement. But the most important part about or not the most important, but a very important part about the income statement is the net income. And although our gross and total revenue has been growing with Tesla the past few years, when we go to net income, we can see that only the last year the net income has been growing tremendously. Obviously there has been growth the previous years, but we can see in 2018, 2019, they have actually been losing money. Only in 2020 and then obviously 2021, their income has actually increased. This is just a quick way to analyze whether a company is growing, whether their revenue and their net income is growing. When we jump to the balance sheet, we can just quickly look at the assets. Obviously, Tesla's assets has been growing, their current assets has been growing, their total cash position has been growing, it has been declining the last year. And then we just want to see that their liabilities is not increasing by too much. And ultimately we want to see that the shareholder equity is increasing. And clearly, again, we can see that this is happening. The last thing that we want to look at is the cash flow statement. And this is, in my opinion, the most important statement to look at, because cash flow is where we can see whether a company is doing really good or not. And cash flow is ultimately what will help a company through a recession or a depression or stagflation or inflationary times. When we scroll to the bottom, the most important thing to see is free cash flow. Clearly, we can see that Tesla has been growing their free cash flow. Here we can see the last couple of years, or the last 3 years, they have been growing their cash flow pretty well, and they were able to save quite a lot of cash. Free cash flow is one of the most used and important metrics in investing. It is the amount of cash the company is producing. Companies use their free cash flow to either reward shareholders or invest in more growth in their company. How we calculate free cash flow is using our operating cash flow and deducting our CapEx, also known as capital expenditure. The way you can think about this equation is that we are taking the total amount of money that was generated by the operations of the business and subtracting the cost to run the actual business. This is why it's very important to see free cash flow growing on a company's free cash flow statement. This is something that I love to look at, and what you guys can do is you can go and look at different companies' financial statements to see whether these things is actually in a positive uptrend. Is it up and down, or is it something that has been stagnating the past few years? The next step that I want to show you guys is to actually see the price to free cash flow ratio of a company. And in this example is going to be Tesla. And this is something that I love to use to determine whether the stock is trading cheap, or it's actually super expensive, or it has an average price. Okay, so the price to free cash flow is basically like the price to earnings ratio. It's just instead of using earnings, we use free cash flow. Or instead of calculating earnings, we are calculating free cash flow. So ultimately with Tesla, they have been trading for a very high price to free cash flow ratio. Here we can actually see that the high it has been trading at was 521. So we are paying 521 times free cash flow, which is very, very expensive. The average is actually 185. Again, it's very expensive. And the latest they have been trading is 113. Although this 113 is quite expensive for a car company or a technology company, whatever you think Tesla is, ultimately we can see that it's definitely trading below its historical average. And let's just have a look back. Let's see, in November 2021, they've traded at 475, and now we can get the company for only 113 times free cash flow. This by no means is an indication to show, okay, we should buy this company. I just wanted to share this with you guys so that you can see this is a great starting point to determine whether a company is cheap or not. What I'm going to do is I'm going to add another company, and this one is Alphabet. It's Google, no one calls it Alphabet. Let me just wait for this to load. And this is where I can see whether Tesla is a good buy or not. When I go to Google, here we can see that the average is 31, the low was 20, and the high was 40. The latest is 21. So we are currently trading at a 21.49-ish free cash flow ratio, which is very low for a big company like Google. And why I'm telling you guys this is, if we just have a look back, let's say around 8 years back. So Google is basically selling for the lowest price to free cash flow ratio that has been selling in almost 8 years. And this to me is a very good indication that it's a good time to buy Google. If we just go back and we search Alphabet here, and we go to their financials, again we can look at all of the things that I showed you guys, but I'm just going to jump to the cash flow statement and scroll to the bottom, and here we can see the amount of free cash flow Google sits with. And the past few years Google has been growing their free cash flow tremendously. So Google is sitting with $67 billion of free cash flow. So I can buy Google for 21, let's estimate it 21.5 times free cash flow, which is very cheap. Obviously, the higher price to free cash flow is, the more we are paying for the company, and obviously reversed as well. So this is something that I love to use, and I kind of like to compare these two companies with each other. There's a lot of hype behind Tesla, and another thing that I just wanted to show you guys, if we go to general, let's just quickly check. Obviously I have nothing against Tesla, but their price to earnings ratio is 93 at the moment, and that's really quite expensive, even though the stock price of Tesla has been dropping tremendously. So I would love to buy a company like Tesla, but I would definitely wait for its price to earnings or its price to free cash flow to drop quite a bit before I'm interested in investing in this company. With a company like Google, I will definitely jump the wagon anytime. Another company that I wanted to show you guys is Alibaba, and I'm just going to jump to the cash flow statement again and show you guys the amount of free cash flow that this company has been generating. And this is in Chinese yen, so it's not US dollars. I don't know the exact amount, I just know that it is quite a lot. And here we can see how they have been scaling their free cash flow until the last year. Obviously, this has a lot to do with the Chinese government, and there's quite a lot of things that created this problem. But before we go ahead, I just wanted to show you guys again the price to free cash flow of Alibaba. And let's just wait for it to load. Here we can see that Alibaba is trading at a 18 times price to free cash flow, which is very low. The highest it has been is 56. So we can basically get Alibaba for quite a big discount. This is by no means the only research that you have to do when buying a company, but this is a great starting point to kind of determine whether you want to invest in a company or not. The purpose of this video is to explain to you guys that times can be tough, and we are in tough times now. If you are serious about investing, you will have to bite the bullet and invest in a market when it's down and it's not euphoric and everyone is afraid and scared to invest their money. Just remember to be fearful when other people are greedy and greedy when other people are fearful. With that said, I hope you guys enjoyed this video. And I would like to make a full fundamental analysis video on a specific company, but it might be a bit boring for most people. So let me know down in the comments if this is something that you would like to see. If you like this video, give it a thumbs up, subscribe to my channel if you haven't already, and I'll see you guys in the next one.